Futures. We're going to look at futures contracts, the markets, hedging, trading strategies, and financial futures. There's two markets here for commodities and futures. The cash price, which is immediate delivery, which could be, that's called a spot market, and it could be 2 or 3 days, actually. The futures market is an organized market for trading futures. Where options were an option, futures are a commitment. You are committing to deliver or accept delivery of a certain amount of a specified item on a date at the price. When we talk about commodities, we're typically talking about like agricultural, metals, that sort of thing. Fungible, like every share of IBM stock is fungible. They're all exactly the same. Every dollar bill is fungible. It's exactly the same. Fungible goods that are qualitatively the same regardless of the supplier. Now, we'll see when we look at like corn futures, how they handle that, but that's what fungible means. A commodity, they're usually talking raw materials, agricultural products. There's some others, but grains, it started with grains and livestock in Chicago. Energy, metals, food. Financial futures is where the market is 90% now. Foreign currency, interest rates, stock indexes. Here's the characteristics. It is like an option, a transaction that will not be completed until the future. The delivery date and the quantity are set when they create it. It's legally binding. The seller is legally obligated to deliver. The buyer is legally obligated to accept delivery. Now, you can hold them or you can trade them back. You can close out your position. And the vast majority of them are actually closed out. They're not delivered against. People really do not get corn futures delivered to them. Delivery month is like the expiration date. Their trading hours vary. Electronic trading is, it's all over the place now. Everyone has got a different contract size because it started out dealing with agricultural commodities. So some investors wanted it 50,000 bushels and some wanted 5,000 bushels. So different contracts are different sizes. It seems confusing to us because we're getting ready to see a list of it. But if you were a trader, you would only be dealing with live cattle and feeder cattle, and it wouldn't be a big problem. You wouldn't have to, that's all you need to remember. Or you'd be dealing with corn, wheat, and soybeans. All trading is done on a margin basis. Now, options trading, you have to pay the premium at the time you buy the option. There is no margin. This is done on a margin basis because it's mark to market every day. Here's the futures contract sizes. Look at them here. 5,000 bushels, 40,000 pounds, 100 troy ounces, 125,000 euro. It's set based on whatever they believe investors want. Option holder has the right. Futures holder has the obligation. Strike price is in the contract. This price is set by supply and demand. Option holder, the loss is limited to the price. There is no limit on the loss for a futures contract. Option price paid in full. Futures is traded on margin. Chicago Mercantile is the big one. It's called CME Group now. Chicago Board of Trade started in 1848, and they've merged with CME, CBOT, and New York Exchange, and they've all merged into CME Group. 95% of all the trading goes there. They have for years done open outcry, which is really neat to watch, and they're getting them. When you watch them do it, you can't believe it works, to tell you the truth. They shout out orders, and they're wearing bright colored coats and all this kind of stuff. You really can't believe that it works. They use hand signals to trade. A lot of it, no surprise, is going to electronic trading. We visited the CBOT when I was in Chicago quite a few years ago for a convention, and we got to go on the floor. We went on the floor on the, there's two big trading floors. One's financials and one is agriculturals. Well, let me tell you, over on the reason we went to the financial side, because the people are like our size, over there on the agricultural stuff, it's like ex-football players are over there. I would be trampled in the rush over there. And they are, it was really wild. And it's just that loud and just that, it was really neat to see it. Globex, CME Globex, Global Electronics Platform. As you might imagine, electronic trading is a lot more efficient. It's not as colorful, but it's a lot more efficient. That's what the trading floor looked like. And if I had to guess, I would say that's the financial side. They're trading in pits and they're tiered down. You see they've got on all different colored coats. And let me see if I can find one. Somebody up in it. Well, he's probably up on a little chair. There's somebody out in the middle of each little pit. And if you and I decide to trade, we turn and signal him, and he makes a record of it. We're making a record of it, but so is he. And that's how it's cleared at night. If you see him do it, it's amazing that it actually worked. That is probably the agricultural side. Imagine being out there trying to trade something. It is, they do it with hand signals. I'm buying, I'm selling. Contracts are traded through the exchanges. You buy them and sell them just through your broker. You can buy and sell through your broker. Same types of things as stock orders, market order, limit order. Long is buying a contract, short is selling one. Long, you want the price to go up, short, you want it to go down. Only about 1% are actually delivered. Even when the person buying actually wants the commodity, it's still only 1%. Open interest is the total number of contracts open and not settled at any one time. It tells you where the trading is, where the hot interest is. And there are commissions on this, of course. Margin trading, you have to put up initial margin, could be anywhere from 2 to 10%, depends on whether you're a speculator or a hedger. Maintenance margin, that's the number that you have to stay above at all times in your account, or else you'll get a margin call. You'll have to bring it back up to the initial level. It's mark to market every day. Daily adjustment. The reason for mark to market is because if my investment starts losing value, I may just walk away. Well, if they mark to market and force me to come up with money every day, and again, they've got a clearing too, futures clearing as well. I don't think they've had a default either. Let's see an example. Molly believes gold prices will increase. She takes a long position in gold futures, price $1,300 an ounce. Her broker requires $1,000 per contract, initial, $750 maintenance. That is way low. It says it down there. So she puts up $1,000. Okay, she puts up $1,000. There's her maintenance margin. She's good. They buy one contract at $1,300. She's got $1,000 equity. She's still good. The price goes down $2, but it's for 100 ounces, so that's $200. That comes down $200. She's still okay. Price comes down another $4. That's $400. Now she's not. She's going to get a margin call to bring it back up to $1,000. So that's how marking to market works. Here's what the margin requirements are, and you can see there is the one for gold. It's quite higher than that. Major types of commodities. Here's some weird ones down here. Weather, interest rates, freight, lumber. The weather is kind of strange. Type, product, and deliverable grade. The exchange where it's traded. The contract size. It could be in bushels, pounds, tons, metric tons, anything. The price could be cents per pound, dollars per pound, whatever. Tick size, delivery, expiration, and the price limit, and how it's delivered and settled. Now, what they call the settlement price, we would consider the closing price, and it typically is. In the past, the settlement price, there was actually somebody, a committee, a little group, that looked at the closing price every day, and if some odd trades had gone off that were really off kilter, they might pick something else as the settlement price. Because it's so important, that's what determines the daily mark to market. Volume, how much was traded that day? Price change, because as you saw, that $2 price change was a $200 change on gold. They've got limits on theirs. The daily price limit is how much the price can change before they stop trading, and the maximum range. Here's corn futures. Up here, the unit is 5,000 bushels. The prices are quoted in cents per bushel. Method is deliverable. Look down here. This is the fungible part. That contract is for number 2 yellow corn. Number 1 yellow is at a 1.5 cent per bushel premium. Number 3 yellow is at a 1.5 cent bushel discount. That's how they equalize out. And if any of these other contracts you'll see, like for cocoa, I did some research on that one years ago. Certain types of cocoa have a premium on them, certain have a discount. So that's what kind of equalizes it out. Here's your corn futures. See the price, it is quoted as 453.4. The prices are in cents and eighths of a cent. So 453 is $4.53.5 times 5,000 bushels. And there's your high-low limit over there. Futures prices from the Wall Street Journal. There's your metal, petroleum, copper, gold, platinum, silver, crude oil, light sweet crude, and heating oil, and your interest rate futures. Those are very heavily traded. Just as an look at the open interest on the T-bonds and the Treasury notes and the euro dollar down here. Very heavy on the open interest. And agricultural, corn, ethanol, oats, soybeans, etc. Feeder cattle and live cattle, pork bellies. Currency futures and index futures. My personal favorite is cocoa. And here it is, cocoa futures. I picked it to do a project in a class one time because the professor wanted everybody at the beginning, it was on derivatives, to pick a commodity and become like a little mini expert and tell the class about it. And I'm thinking, so you pick something you like, gold. He followed gold stocks. Not a good option there. That wasn't a good choice. So I picked cocoa because I figured I like chocolate. This will be good. So my cousin is a commodities trader with Smith Barney then. He's with J.P. Morgan Chase now. And he said, how could you pick cocoa? Pick soybeans. Everybody here trades soybeans. Nobody here trades cocoa. They trade cocoa in New York. So I had to get hold of somebody in New York to find out more about it. Around here, we trade a lot on soybeans. It's traded on the New York Board of Trade, which is now ICE. The contracts are March, May, July, September, and December. They are meant to match the harvest season for the cocoa bean. Contract size is 10 metric tons. Metric ton is 2204.6 pounds. And it'll take delivery in ports of New York, Delaware, Hampton Roads, Albany, or Baltimore. And yes, they'll tell you all those different things on each type. Now, trading strategies. You can speculate in them. Boy, that's risky, but you can. You can spread, which captures some of the benefits of the volatility. And you can hedge. Hedging is almost exclusively people who either are producing the product or need the product. Speculating, like anything else, you're hoping to catch something on the swings. Spreading is a bit more conservative, restricts your loss and a little bit of profit there. Hedgers are the ones we normally think of. Either the business produces or uses a commodity, and they're going to need it. Think cereal maker, he needs grain continually. The farmer is planting and producing grain. Here's the idea. It makes revenue more predictable, but it locks in the price. It locks it in. We'll see an example. Hedging, you do now in the future market what you will have to do in the future in the cash market. A hedger is a natural in the market. The farmer who plants in the spring is a natural long because he's going to have to sell in the fall. The cereal maker is a natural short because he's going to have to buy. He's continually having to buy grain. Now think about using the futures market. He can buy futures contracts and know what his price is. Now he's locked it in. If the market moves the other way, he's still locked in, but at least he knows what it is. Farmer who plants soybeans in the spring to sell in the fall, he's a natural long. So he sells into the futures market now. Sells his crop, expected crop output into the market now. Most of the time, by the way, they do not actually deliver against it. They actually close out. It's like protection. Cereal maker needs grain, so he hedges, he goes long in the futures market, futures contracts, because he's locking in a supply of grain. Speculators trade just to earn a profit. But speculation kind of has a bad name. But the truth is, you have to have speculators to take the other side of the hedge. The hedger is trying to reduce his risk. The speculator is basically saying, I think you're wrong, I'll take it. So they're the ones who provide the liquidity in the market, because every trade's got to have another side. Buying futures, establish a long position. You profit every day the new price. If the new price is higher, You have profit and it goes into your account. If you have more than your required margin in there, you can withdraw from it. You can withdraw it. If the new price is less, you just saw it there in the marking to market. Here's your example. You think price of gold is going to go up. So you go long 100 futures contracts for 3 months. Price today is $1,300 an ounce, $100, 100 ounces. So you're in for $13 million. If the price of gold is $1,320 when it expires, you just made $200,000. Now think about how this is different from options. Options, the price is set at the time you buy the option. This, you bought in, but you're hoping the price moves. A short is exactly the opposite. You go short 100 futures. Your position is $13 million. Again, if the price drops, you profit, just like buying stock. Commodities. Let's look at return on invested capital. It's all capital gains. There's no income on a commodity. Very volatile, but there's a lot of leverage here. Here is the formula. The selling price minus the purchase price divided by the margin deposit. That's where you can make good money. Okay, financial futures. Futures contract in which the commodity is a financial asset, or it could be a basket, whatever. You can offset interest rate risk. You can minimize foreign and currency risk. The currency future trading back in 1972, when ownership of gold opened, 1974. T-bill futures, 76. Treasury bond, euro dollar. Today, the financial futures is the bulk because the commodity, the physical commodity side has diminished tremendously. CME Group, CBOT, CME, and LIFE, London International. Foreign currencies, interest rate futures, and stock indexes. Currencies, they have futures on the big main ones. British pound, Swiss franc, yen, the euro, of course the dollar. Interest rate, treasuries, Fed funds, interest rate swaps, euro market, government. Stock index futures are settled in cash. Obviously, you could not deliver the S&P 500. Financial futures, they're similar to commodities. They have varying delivery months, 12 months or less for a stock index. Interest rate futures are typically longer. They could be 2 or 3 years. Kind of interesting. Here's how they work them. We're going to see examples of it, of course. The big Dow is 25 times the index. The Dow is 10, S&P 500. Again, I do not expect you to know these because if you worked in the area, you'd know the ones you worked with all the time. Currency futures are quoted in directly, US dollars or cents per unit of the underlying currency. Interest rate futures are quoted as a percent of par except treasuries, which are quoted in 30 seconds. See down right there. 146, sometimes it's a colon or the quote there. 146 and 1830 seconds, so you convert that. And stock index futures are in terms of the underlying. So the Dow $10 is 13,155 when the index is 13,155. Here's some Canadian dollars futures. Contract is for $100 and it's quoted as Canadian dollars per US dollar. These are Treasury bond futures. See how they're quoted, 149.21. And the E-mini Dow. It's $5 times the index, and there's the quotes. You can speculate in them. Like options, you've got a lot of leverage. You can control a lot for a short period of time with less money. If you think it's going to go up, you go long. If you think it's going to go down, you go short. Pretty straightforward. Interest rate futures are a little more, If you think long-term interest rates are going to rise, rates will go up, the futures values will go down. You short 2 June 2016 T-bond contracts at 147. Contract value then is $294,000. Initial margin, you put up 75.60. If the rates do rise, the contract falls to 138.16. Remember, the contract is the price of the bond. Now, if it falls, then you buy the cover to cover your short. You make a $17,000 profit. So interest rate futures are a little bit opposite, I guess. You can use financial futures to protect a stock or other securities. Stock index futures hedge against stock portfolios. Interest rate futures to hedge bond portfolios. And foreign currency. So suppose your company's contracted to buy products from Japan in 3 months for 2 million yen. Today's exchange rate is 78.21 yen to the dollar. So 2 million yen is $25,000, more or less. You're afraid prices are going to move against you. Is your company short or long the yen? You're short because you're going to have to buy yen in 3 months. Here's what they've got out there right now. 2 million yen would currently be, this right here, at the 3-month forward rate, 2 million yen would be 26,143.79. If you enter that contract right now, you've locked in the price, 26,143. Now, that's good from a business planning standpoint. You know what it's going to be. If prices move the other way, it costs you some money. In other words, you could have gambled that it was going to move for you, but this locks it in. Suppose it's reversed. In 6 months, your company's going to get 4 million yen for something you're going to deliver. Well, now you're long. You're going to receive it, so you need to sell it. If rates move like you expect, you'll be okay. If not, you can lock it in by shorting it, selling them now. Do in the futures market now what you're going to have to do in the future in the cash market. Stock index futures, you can protect a whole portfolio. This red is up here because I don't think it's in your book. The basis is called, this is really strange because sometimes the basis is cash minus futures and sometimes it's the other way around. Here's the thinking. In a carrying, what they call a carrying charge market, the futures price is greater than the cash price because commodities have storage cost. So if you want them out in the future, you've got to store them. Interest rate futures don't have a storage cost. An inverted market is the other way. This is also not in your book, but I added a homework problem on this in the little thing I'm going to show you. Spot futures parity. This is true of a non-carrying charge market. This is like a stock futures. If I want to know what the future price of it should be, the spot price times the risk-free rate, number of periods to contract maturity. The logic is when you're holding stock, the only cost for storage is the cost of money. Current price on a non-dividend paying stock is $25. Risk-free rate's 5.5. Futures contract 6 months. There it is. Should be $25.68. Futures options. Options that give the holder the right to buy or sell a single standardized future contract. This is what my cousin says that that's what they're trading a lot more now because it gives you more flexibility. Because you have the option to not exercise it if you don't want it. Significant advantage over a futures contract. And he's traded soybeans forever. He's an Ole Miss grad too. Let me just kick that in. Because it limits the buyer's loss to the exposure to the option. And here's quotations on corn futures options contracts. Calls and puts. Josh Rink considers himself a shrewd commodities investor. So not long ago, he bought one July cotton contract at 54 cents a pound, and he recently sold it for 58 cents a pound. How much profit did he make, and what was his return on invested capital if he had to put up $12.60 in initial margin? He made 4 cents a pound. The contract is for 50,000 pounds, so he made $2,000, and he put up $12.60. This kind of makes you want to go out and try this, doesn't it? Number 2. You just heard a news story about mad cow disease in a neighboring country. You believe that feeder cattle prices will rise dramatically in the next few months as buyers of cattle shift to U.S. So you go to the CME and find out that feeder cattle futures for delivery in April are currently quoted at 88.8. Contract size is 50,000 pounds. What's the market value of one contract? There it is. That's cents. Number 3 says, you decide to act on your hunches about feeder cattle, so you purchase 4 contracts for April delivery at 88.8. You're required to put down 10%. So you bought 4 contracts, 1 contract value, you had to put down 17,760. Now number 4 says, as it turns out, you were right. spot price rose to 101.2 on the delivery date. What was your return on invested capital? Contract value at maturity, those are cents, mind you, so you divide by 100 times 50,000. That's what you paid for it, up here somewhere. So that's how much you made on a contract, on 4 contracts, and that's how much you put up. That was your equity required from back up there. Taryn Arsenault is a regular commodities speculator. She's currently considering a short position in July oats, trading at 248. Her analysis suggests that July oats should be trading at about 240 in a couple of months. If she's right, what kind of return on invested capital will she make if she shorts 3 July oats contracts, 55,000 bushels, an initial margin of 540 per contract? Okay, there's her initial contract margin. She shorts 3. If she thinks it's going to go down, there's her profit, total profit, 1,200 divided by 1620. George said he is thinking about doing some speculating in interest rates. He thinks rates will fall, and in response, the price of Treasury bond futures should move from 92.15 to a level of about 98. Required deposit of $13.50 per contract. What would his return on invested capital be if it behaves as he expected? First off, you got to convert that to a percentage. It's 92.46875. So his profit is 98 minus that times $100,000, because that's a percentage. That's what the contract is. And he had to put up $13.50. So remember, return on invested capital is ending minus beginning divided by margin, not by beginning like our usual. Number 8, Tori Reynolds has been an avid stock market investor. She manages her portfolio. She thinks the market's headed down, and she decides to short sell some S&P 500 index futures. She shorts 3 contracts at $1387.95 and has to make a margin deposit of $19,688 for each contract. How much profit will she make, and what will be her return on invested capital if the market does indeed drop so that the CME contracts are trading at $13.52? 3 contracts, that's her margin per contract. Beginning value, S&P 500 contract size is 250 times 1387. Ending value is 250 times 1352. 346 minus 338. She shorted it, remember, and went down. And she put up 1968. That's per contract. We just didn't bother with the 3 part. If you're going for percentage, it doesn't matter whether it's on 1 or 3. Let's get our last 2 here. A quote for a futures contract for British pounds is 1.6683. Contract size is 62.5. What's a dollar equivalent of the contract? That's USD to the dollar, because that's how they're quoted. So you just multiply it. 1512 says you purchased a futures contract for euros. The contract is for 125,000 euros. The quote was 1.1636. On the delivery date, the quote was 1.1050. If you took delivery, how much would you have after you convert back? At the time and at the end. You bought them for that, sold them for that, you lost money. And here's my little spot futures. There are single stock futures. Is available on ABC. Trading at 35, contracts for 3 months, risk-free rates 5. What should be the price of the futures contract? There's your formula right there.